Matt the Mortgage Guy, Mortgage Mondays, episode 17, where I'm talking credit score. Matt the Mortgage Guy, Mortgage Mondays, episode 17. I'm talking credit score, and as you can imagine, it's something that comes up quite a bit when someone's applying for a mortgage. So I get to talk to quite a few people in regards to their credit score, how to improve it, why it is at the number that it is, and things of that nature. So I want to give a brief snapshot of what FICO uses to calculate your credit score and what you can do to improve your credit score. And first off, the biggest component of your credit score is your payment history. Over the last 7 to 10 years, have you paid on time with your bills? And that's a given. If your credit score reflects how likely you are to repay future payments, the best reflection of that is how you've done in the past. If you've paid your payments on time over the last 2 years, 5 years, 7 years, it's over the last 7 to 10 years is the window that they're looking at. So if you've had a good payment history, that's over a third of your credit score, 35% of your credit score. The next biggest component, which is 30% of your credit score, is something they call credit utilization. It's a fancy term to say how much of your credit limit are you using. If you've got a $10,000 credit card and a $5,000 credit card, you've got $15,000 in available credit. If between the two cards your balances are $14,800, you're using up 99% of your available credit, and that's going to reflect negatively on your credit report. And if you want it to reflect positively, you want to be around 8 to 10% of your total credit limit. So if you've got $15,000 in available credit over 1 or 2 or 5 credit cards, you want to be having balances of $1,500 or less, and that looks good. As you can imagine, you've got $15,000 in available credit. You're not using it all. This looks good to the credit agencies. Looks good to people that are going to lend you more credit. The next one down is the length of your credit history. This is 15% of your credit score. Has to do with how long you've had established credit. If you've had different forms of credit, whether it be retail cards or car loans or mortgages for 20 years, you're less of a credit risk than somebody who just in the past year or two has started to establish a credit history. So length of credit history is 15% component. The last two components that make up your credit score that each comprise 10% of the total score is new credit and credit mix. And as far as new credit is concerned, as you can imagine, it's not going to look good to the credit agencies if you go out and get 5 new forms of credit in a 1 month period. You get a new car loan, you open a card at Kohl's, you apply for a mortgage. That is going to affect negatively on your credit report. So even when you're trying to establish credit, try not to do too much at once, as this will reflect negatively on your score. And your credit mix. A lot of this is common sense stuff, but a new lender is looking at you as a credit risk, and that's all a credit score is how risky are you to loan money to. And so your credit mix, if you've been able to pay back and make timely payments on a number of different forms of credit, whether it be revolving, installation debt, you are going to see that reflected in your score. So in conclusion, there's 5 things that make up your credit score: payment history, credit utilization, length of your credit history, new credit, and credit mix. Any questions, as always, feel free to reach out. Matt the Mortgage Guy, Mortgage Mondays. Until next time.